Coming up today, a massive rotation into small caps, why this could be just the beginning, inflation comes in better than expectations, all the knock-on effects from the report, and will Biden get pushed out of office? Let's go, guys. Welcome back, optimists, to the most positive investing channel out there. My name's Jared. I'm going to tell the tale of today's tape for you, get you all up to scratch. And first off, let me just start off by saying thanks to everybody for their feedback on yesterday's video. Obviously struck a chord with a lot of you. Actually had a few people reach out and said they've been victim to bear porn, which was unfortunate to hear. However, I don't blame anyone. That's just kind of how we're hardwired and have evolved. To be more aware and vigilant of threats than opportunities, just kind of the same way how the sensation of a loss is greater than it is for the equivalent win. Unfortunately, a lot of dodgy content creators play on that, and so they'll do just like the mainstream media, fear-inducing headlines to keep you paralyzed in fear, and that's really bad for your mindset, yet alone your investing results. So like I said yesterday, going forward here on the Click Capital channel, we're going to have a more positive, optimistic approach. There's always a bull market out there somewhere, and that doesn't mean we're going to ignore the risks, nor will we be paralyzed by them. Instead, we'll be in that middle ground, and we'll acknowledge and be aware of the risks, and where possible, try to turn them into opportunities. So if all that sounds up your alley and you would like to get more of this content, then go ahead and smash that like button to let the algo know that you prefer to see positive investing type content instead of the typical bear crap that most other content creators are pushing upon you. Okay, so let's dive right in today. I've got an interesting one for you because we've got some historic records going on today, some big moves and a lot of key markets, namely a monster and on some measures a record rotation out of mega cap tech into small caps and some other sectors today that I'm going to show you. Here's a composite chart of the Magnificent Seven, down a huge 3.9% today, while we've got the Russell 2000 up over 3.5% on absolute monster volume, pushing up at the top of this range here, which I think we can put in a resistance box right there, and that is really strong price action. It's showing up with a breakout in volume breadth and market breadth as well across all time frames. Really sharp breakout and stocks making new highs. Volatility is still subdued, but just look at that spread of the Russell 2000 versus large cap stocks. Regular viewers of this channel know I've been pointing out of late how technically and fundamentally oversold small caps are to large caps. Got some of my reversal signals there a few weeks ago. Traded up for a bit of a week. Market quite often will come down and retest. That's how we get double bottoms and bullish divergences. But just look at that monster green candle. Really good signs of accumulation here. And this is in tandem with a sharp pullback in short-term government bond yields on the back of that cool inflation print. So what does that tell you? The bond yields pulling back, inflation cooling. A lot of people are saying when NVDA and all these other companies roll over, that's going to bring the rest of the market down with it. However, as you all know, I've been arguing the opposite. Instead, I was calling for the mother of all rotations back into small caps, and this could be just the beginning because I think the Fed is likely to cut rates in September, and this could provide a really good tailwind for this trade, and hence why I've positioned my portfolio to take advantage of this. And so even though the S&P, Nasdaq, mega cap tech was down big today, the Click Capital Stock Picks portfolio had another up green day today, and so far members are very happy right out of the gate. And so if you've been thinking about joining my new stock pick service, then time is running out. To save 40% with coupon code STOCK40, click the link below this video and jump on board. To find out what my latest stock pick is, it's already doing well, and you'll also get my next pick that I send out every Sunday morning. Because like I said, looking at this chart, small caps have been beaten down for so long now. This isn't just a swing trade, something I think could go on for a few weeks. This is something I think could go on for a few years and potentially even a decade or more, looking back at history. And there's plenty of hard data to support my view and positioning on this. Just looking at fund manager positioning, really at the top end of the range for being long growth stocks, and down near almost the bottom of the 20-year range for being positioned in small and mid caps. In fact, they're about 70% net short. And so I'd say part of that move today was a lot of short covering from some hedge funds, a bit of an unwinding of this trade. And you can see the gap between these two charts, like a bit of a Jaws gap. And so there's plenty more unwinding to be done on this trade. And again, just looking at the data, since the odds are we are about to go in a Fed rate cutting cycle. That bodes well for small caps. Just looking back in history, in the first 12 months after a rate cut, small caps on average returned 26.6%, well out in front of large caps at 15.6%. And that's because small caps are more sensitive to interest rates. They rely a lot more on debt than large caps. And in fact, these high interest rates have been holding a lot of them back from increasing their profits. So lower rates are much more of a tailwind for small companies and large companies. And just looking at a scatter plot of the relationship between the relative forward PE of the Russell 2000 versus the Russell 1000 and subsequent 10-year annualized relative returns. Here we are now, right around here, very low relative forward PE of smalls versus large cap, and then the subsequent return is quite positive as well. And the fact is, bull markets last a lot longer than what we all naturally think. Current bull market, about 21 months old. Looking back in history, most bull markets last about 61 months. And yes, we've been in a secular bull market since March 2009. However, there have been periods in history where secular bull markets have lasted 18, 20, 24 years. And so currently at 15 years long, there's still potential. We have a few more years left just yet. And a big part of this bull market, of course, the AI boom and the explosive growth in data centers. And that's not just going to benefit mega cap tech. Like I've been saying, I think that's going to flow out into other areas of the market that we've kind of already been seeing. And just look at this stat here. More data has been created in the last 3 years than in all of history. Just absolutely exploding. And so artificial intelligence could still be in the early inning, and the power that it requires is so much dramatically more than what the industry's been built around. For example, already ChatGPT uses 10 times more computing power than just a Google search. And when AI produces an image or videos, that goes up dramatically. And the year-over-year increase in capital expenditure, 45%. Companies are expected to invest almost $200 billion in data infrastructure this year. And I'd say for this bull market to really get knocked over, cut off at the knees, you'd need this spending to really roll over as well, which I'm not saying is not possible. However, we follow trends here, and the trends are up, and as long as it remains up, we're going to ride along with that trend and not go against it. That's why my first pick was Palantir, and it's already up over 20% since I bought it. So when you see this bear porn out there like this meme here, suggesting the whole US economy's been held up only by NVDA and Taylor Swift, don't be fooled by it. The US economy and capital markets are so broad, have so much breadth and depth to them, and it's not completely reliant on one company or pop star. However, that being said, large cap companies are richly valued. We've got a historic gap here between the S&P 500 cap weighted trailing PE at 24.5 and the equal weighted trailing PE at 17.7. But not only in valuations, also technically speaking as well. In the black here is the top 10 company of the S&P 500. In the purple is the bottom 490. And again, looking over the last 4.5 years, we've got a historic gap between the biggest companies and everything else below it. And we're in a very low VIX environment. A lot of people out there think that's really bearish. However, the fact is volatility moves in regimes, and it can stay there for quite some time. Again, longer than what we naturally think. Just looking back in history. On this chart here, the consecutive number of sessions with the volatility index below 14. We're starting to get some clustering. And just looking back in history, we've had 3 instances of years-long clustering. 2013 to 2020, 2004 to 2007, and back in 92 to 96. And typically, when the VIX stays persistently low, again, the data suggests that's good for forward returns, and the bull market can usually keep going on for a few more years. And like you see in previous peaks, and I pointed out on yesterday's video, volatility will actually increase before the market tops out. We saw that again in 21 as well. As things start getting a bit dicey and option dealers price in a correction, just something they're not doing right here. And just keep in mind, even though we've had weak market breadth of late in the short term, all stock sectors are above their long-term 200-day moving averages. The long-term trend is up across the board. And in fact, looking back in history, when more than 8 of the 11 S&P stock sectors are above their 200-day average, the annualized return going forward is 13.5%. The funny thing is, it's the same deal when fewer than 2 sectors are below their 200-day average as well, because that's a sign the market's bottomed out. However, in that middle ground, when you've got 2 to 8 sectors above their 200-day average, that's when we actually see negative annualized returns. So here we are now, all 11 sectors above their 200-day average. Again, confirming the trend is up. And the good thing about being a permabull, as I've been called, is the most powerful man in finance has got our back, Jay Powell, with the ability to literally create money out of thin air. Can switch on that printer at a moment's notice, backstop the markets, we can lean into that, buy the dip, and just like the storm clouds clear and the blue skies come back, so does the market, just like it has done for over 200 years now. And it's not just small caps and value stocks that have been beaten down for years now, also emerging market equities. And like I say, America definitely deserves a valuation premium, but just relatively speaking here, on technicals, emerging markets versus US stocks, one standard deviation below the average. Looking back in history, last time we saw that in the late 90s was a great time to get in emerging markets. Along with commodities, small caps, they rallied really hard up until the GFC. And even though the largest country in these emerging market funds, China, had been in a 3-year-long bear market, most investors around the world had given up on it. Institutional money is coming back into Chinese shares. We can see that with cumulative flows into emerging market equity funds. In the light blue here is China, dark blue is emerging markets excluding China, and that has accelerated this year. And there's a look at the most popular Chinese large cap ETF, FXI, up over 2% today, above the 50-day VWAP, bounced off that support zone I had in there beautifully, and we're just a few days out from their large CCP meeting, We might get to hear some new economic measures and stimulus. And like I said back here, the market may get a little excited going into that. But overall, the price action and trend is looking pretty solid here. And ever since Xi Jinping met with American business leaders a couple of weeks prior to hitting a low, stock market's rallied up almost 30% in that time. Another market I like, Singapore, breaking out to a fresh 52-week high today, along with South Korea and Brazilian shares. High highs, high lows on a spinning doji. So what caused this huge rotation today was the monthly CPI inflation report coming in better than expected, showing we actually got a little bit of disinflation month over month, with the headline number declining 0.1% from May, putting the 3-month rate at 3%. There's a look at the year-over-year change, and it looks like we may have just put in a lower low, and this downtrend could be accelerating. Again, we just follow the trends around here, and it's clearly showing some disinflation setting in. There's the month over month going negative for the first time in years. There's a look at CPI categories, year-over-year change. Again, you're welcome to pause your video player to take a deeper look. Still leading out the front is motor vehicle insurance. However, you've got to keep in mind the insurance industry and its pricing is very lagging. So that's still blowing out from the last couple of years, and that's bound to pull back as well. And what had been a big one in the past few years, used cars, is now down the bottom of the list. Overall, still 3% year-over-year increase. What's also helping the picture is shelter. That's been helping to keep inflation high, and that got cut in half from May, increasing 0.2%. Now, hearing from some Fed speakers like Goolsbee, so this report's profoundly encouraging, makes a strong case for rate cuts. Saw a similar tone from Mary Daly, indicating she's comfortable with loosening monetary policy. However, not everybody's on board. We still have some Fed members saying they need to see some more data before they can go ahead and cut. But I think the Fed should take any chance they can to help their friends in Washington get that interest expense on US debt down, which has been exploding so far this year. And the fact is, quite often the bond market leads the Fed, does a better job at predicting the future, and that's why we saw short-dated bonds fall a lot more sharply today than long-dated bonds, narrowing the inverted bond yield curve. And so I'd agree with billionaire bond trader Bill Gross. Curve does look to be disinverting, and he suggests to own 2s, not 10s or 30s. And so like I'd been saying of late, it does look like a bit of an elongated head and shoulders there. A bearish formation in the 2-year government bond yield. Got more confirmation of that today, breaking down on this big candle, giving up over 10 basis points. Well, the 10-year is looking similar. However, it only fell a bit over 7 basis points. And there's a look at TLT, having a pretty good gain there today. And short-dated Treasury bond ETF, SHY, fresh multi-month breakout. And look at that in high-yield bonds, pushing up against that resistance zone. Like I'd been saying yesterday, this looks like a bullish pattern, and that's especially easy to see when I go out to the weekly chart here. This could be a big base that's been building all year, and we could be on the verge of a breakout in high-yield bonds, which, like I said, is really positive for risk-on sentiment. That's a bullish move for financial markets. Also helping the picture is the dollar falling down as well. Stocks generally like a weaker dollar, but Bitcoin, which can be argued as a measure of liquidity and risk sentiment, it's just not there. I'm not sure whether that's really important or relevant. Price action is looking a little heavy here. We did have this bullish green candle back on the 8th. I think the market's just kind of stumbling around. Not really sure what to do here. We also saw it spill out to real estate stocks today. REITs, obviously loving lower bond yields. Chance to lower the cost of capital. Increase the margin between their rent. And that's really strong price action on REITs today. Up 2.7% on really strong volume. And just going out to a long-term monthly chart, that's a really bullish sign. When you see a market which typically has 4 stages. Phase 1 advance, Stage 2 distribution, Stage 3 decline, Stage 4 accumulation, then back into Stage 1 advance, breaking out above this long-term downtrend. And when you see patterns like this in the market, they can present really good risk to reward opportunities, as most money is made in the Stage 2 advance. And so getting in early on that confirmation or on the first pullback of a breakout, they can offer up good risk to reward opportunities. And I'd say this is quite a contrarian trade, as pretty much no one is bullish on real estate. And I know looking at residential real estate, it's overvalued on many measures. However, some REITs hold properties like data centers, storage facilities, commercial, industrial, and I'd be more inclined to invest in those areas, as residential real estate in most Western markets is still significantly overvalued, and I don't think you could really call it cheap. And in my opinion, still has the potential to pull back significantly in coming years. We also saw a knock-on effect in the currency markets. Japanese yen jumping up, liking those US bond yields pulling back, helping to close the gap between their ultra-low bond yields, stabilize their currency somewhat. Bank of Japan has a full-time trading desk. They might have jumped on board to try and accelerate that move, maybe doing a little intervention here. We've got a really big candle on the dollar yen today, down almost 2%, which is a good sign for financial markets. We don't want to see the yen get created one of the most important currencies and economies in the world. That could potentially cause some contagion if it were to really let loose. Moving on to commodities, we've got oil holding ground once again. Like I've been saying, price action is firm in crude futures, holding their ground just above $83 a barrel. And this price increase over the last month doesn't really seem to be finding its way into CPI. It's not to say it's not possible. Like I've been saying, a resurgence in inflation is possible. That's a key risk to a lot of equities, but that's a tailwind to commodity stocks. So that's how you can turn that risk into opportunity. We've also got gold sitting pretty. That likes the prospects of lower rates. Gold, a non-yielding asset, becomes more appealing versus yielding bonds. There's a look at gold futures pressing up against all-time highs, now above 2,400 an ounce, with junior gold miners, one of the best performing sectors today, up 3.3%, fresh breakout to a 52-week high. Like I've been saying, they have potential to run a lot further as well. Obviously, the regional banks love these lower yields. Super strong move. Upward momentum thrust on my indicator there today. Obviously, home builders like the prospect of lower rates and a Fed rate cut, up 5.8% today on monster volume. And biotech also doing well, multi-month breakout. Semiconductors, the clear weak sector there today, down 3.6% on huge volume, and this could be potentially setting up a bearish divergence here. I can see that on my DSI, getting a bunch of downward momentum thrusts. You can see that in the tech sector, ETF XLK as well, and NVDA. Not a huge amount of volume, but nonetheless down 5.5%. And look at that, Magnificent 7. Apple down 2.3%. Looking a little exhausted. Microsoft, downward momentum thrust. Alphabet, Google, not as bad. Meta down over 4%. And Tesla, down over 8% on monster volume. Fifth consecutive reversal signal. Downward momentum thrust. And these are some pretty heavy candles here. And like I said today, it was a huge and significant rotation out of these mega cap tech stocks into small caps. And some others as well. Small cap value, 4.5%. Micro caps, 4.9%. And a little bit of a pop in cannabis after it's been beaten down these last couple of months. I'd say pricing in a Trump win. We still don't really know Trump's view on cannabis. The last he spoke of it, he wasn't really in favor of it. However, we're hoping he flips on that like he did on crypto. And so I'm still cautiously optimistic on this hugely volatile sector going forward. I think it's still a long road ahead though. Also saw a big move in Costco today, after they just raised their membership fees for the first time since 2017. However, it's only a small increase, $5 to $65 for its Gold Star and business memberships, while executive membership fee will increase by $10 to $130. These increases will go into effect on September 1. Historically, Costco's increased its membership fee about every 5 years, and it too looks to have got caught up in that monster rotation today, down 4.2% on huge volume, after it's been on quite a tear this year so far. Just moving on across the pond to the United Kingdom, their economy returning to growth in May, beating expectations. The currency, the pound, hitting a 4-month high against the US dollar, with its economy growing by 0.4% in May, more than double economists' expectations. And there's a look at the United Kingdom equity ETF that trades in New York under ticker EWU, trading up today above the 50-day VWAP, and that too has got some pretty good momentum over the last 6 months. We've also got some members in Congress taking another stab at banning all of themselves from trading stocks. We've seen this a few times before. However, it's always been pushed back on by the likes of Nancy Pelosi. Otherwise, how else would her and her husband grow their personal fortune to over $250 million if they can't trade stocks? And Americans have been polled. 83% of them said Congress members should not trade stocks. It's obviously a clear conflict of interest, kind of mind-blowing. In today's day and age, what's supposed to be the world's #1 democracy, we have those running it, trading in the stocks that they actually regulate. Can't have a clean democracy when you got those at the top enriching themselves at the expense of everyone else below. That's how you create social unrest, which again, looking back in history, doesn't lead to good things. And speaking of Washington, just moving on to the latest from Biden, we've got a lot of people on his side of the fence calling him to leave the race, with some Democratic senators saying he needs to drop out. It's done, it's over, as he continues to embarrass the United States on the international stage. Just today at the NATO summit, introducing Ukraine President Zelensky as President Putin. He also just held a press conference in which he called Kamala Harris Vice President Trump, as it's obvious age has caught up with him and he's no longer fit for office. However, the Democratic Party is in the midst of a power struggle. Biden's inner circle wants him to staying very tight-lipped about his health, even though a neurologist has been visiting the White House several times. We're not allowed to know any details about that, and instead, it's nothing to see here, move on please. And just in his most recent conference that happened minutes ago, as I speak now, said he's not going anywhere. He's determined to take on Trump and beat him again. However, the betting markets has still got Harris as the front runner for the Democrats, pricing her in a bit above Biden. These odds are flickering around a lot day to day, but I'd say we could be on the cusp of Biden pulling out in the coming days, if not week or two. We've seen some of his key supporters, Hollywood elitists, even Pelosi now jumping on board. And I'd say that opposition from within his own party is swelling, and that's soon to overwhelm his inner circle. And since he's technically the most powerful man in the world, he really gets to say whether he stays in or not. And right now, looks like he's determined to stay in, but he is quickly losing support left, right, and center. However, as it stands now, if we get a clean election, Trump should be back in the White House come January next year. And what does that mean for us investors? Well, Trump's known as being pro-business, pro-America, and just like his first presidency, he seeks more deregulation, which is good for business. Less rules, less red tape. Market put in a strong rally back in 2015 and 2016 as they priced in a Trump win. And so Trump's obviously big on fossil fuels. He's not too big on clean energy. He really helped to revive America's oil and gas industry, which Biden has largely left in place, still pumping it out at records. Some say LNG, natural gas, could be a clear winner. Goldman expects the change in administration could allow the commodity to be exported again, which had been halted to a non-free trade agreement during Biden's administration. Goldman also expects oil leases on federal land and offshore energy development to expand. And for utilities, they believe restrictions on pollutants from fossil fuel electrical generation would be changed. So basically a bit of a loosening of environmental laws for the benefit of the fossil fuels industry. Let's look at the oil and gas ETF in America, XOP. I think it's pretty clear here. We have a bit of a downtrend line, which may get tested in coming days. And just zooming out to a clean monthly chart on the energy sector, XLE. Believe it or not, still trading at similar levels from 16 years ago, back in mid-2008. Dividend yield of 3.2%. A lot of measures, energy stocks are the cheapest sector in the market. That's why my stock picks portfolio has already got exposure to this sector with the oil and gas services stock, and I've definitely got more energy stocks on my watch list, as there's plenty of good cheap stocks out there with stable dividend yields as well. So this is a sector I'll be paying attention to going forward, especially with the tailwind of a Trump presidency. And here's an interesting chart I thought I'd share with you guys today. Just looking at US wealth by generation. Down the bottom here in the blue is millennials with $13.5 trillion worth of wealth, and they're classifying millennials as being born between 1981 and 1996. In the green, you got the silent generation, born before 1946 with 19.7 trillion of wealth. In the pink, you got Generation X, born between 1965 and 1980, 37.8 trillion of wealth. Well out in the front, baby boomers, born 1946 to 1964, $76.2 trillion worth of wealth. And they actually own over 52% of all the wealth out there, even though millennials now make up the vast majority of the workplace. Looking back in history, these are record gaps. Millennials as a group are well behind their parents and the baby boomers. However, going forward, a lot of that will trickle down back into millennials with inheritances and estates, but that could still be many years off just yet. There's a look at your economic calendar this Thursday. UK's GDP coming in better than expected. America's month-over-month inflation declining for the first time in years. Year-over-year coming in a bit better than expected at 3%. And tomorrow we'll get some PPIs and the Consumer Sentiment Survey. Fear and Greed Index back into the neutral zone at 52. And there it is, Fed Fund Futures. Just like the 2-year government bond yield, now looking over a 92% chance they're going to cut in September. And I'd say after today's report, we'd have to get really surprised in the next couple of prints before then, because I'd say Jay Powell is probably lining up to go ahead and cut in September. But it's just really interesting timing, because that's the last meeting before the federal election on the 5th of November, just a couple of days before the Fed meets. So interesting times indeed. All right, guys, that's all I've got for you today. Pretty significant price action we got. Monster rotation out of mega cap tech stocks into small cap, along with those other key sectors I highlighted for you. I'm really excited to be positioned in small caps. Value stocks and commodities, I really feel like we're close to putting in a secular bottom here, and the good times could be just beginning. If you'd like to follow my portfolio and find out all the investments I'm making before I make them, then click the link below this video, head on over to my website, clickcapital.io, and jump on board my new stock pick service before the sale shuts down in just a few days. Thanks very much for tuning in, and I look forward to making you another video tomorrow night. Cheers.